To me, remember, Bitcoin is kind of the perfect liquidity fire alarm, and it tells you how much liquidity there is in a system to an extent. And it soaks it up. If there's too much, it soaks it up and it goes up a lot. And by the way, when there's not enough, it's also more sensitive than gold. It goes down more. And so to me, the fact that Bitcoin is drawing down is a very good indication that we're getting closer to what I think is going to be a trigger event that's going to lead to the big print.
The overarching thesis is what we've defined on the expansion of global liquidity. The financial world operates on debt and liquidity. That's just what it is. And so that's number one. Number two, volatility is scary.
Yeah.
It's really scary.
Bitcoin's price in November 2025 has been volatile, recently hovering around $85,000 after falling from October highs near $126,000. The cryptocurrency tested support near $82,000 amid increased selling pressure caused by liquidations and cautious investor sentiment. Trading volumes have been relatively low, resulting in a range-bound market where Bitcoin has oscillated roughly between $80,000 and $110,000. Analysts suggest that significant price moves might require heightened market activity and improved liquidity. Despite short-term weakness, Bitcoin remains a key asset considered by investors for its role during financial uncertainty and liquidity shifts. In a recent discussion with Bitcoin Brahm, Lepard explained that Bitcoin acts like a liquidity alarm in the financial system. He noted that when liquidity is plentiful, Bitcoin absorbs it, and its price rises sharply. However, when liquidity tightens, Bitcoin's price declines more sharply than gold. James Lavish added that the financial world fundamentally operates on debt and liquidity, which explains why volatility, though unsettling, is part of the market's natural cycle. Together, they pointed out that Bitcoin's price movements reflect broader liquidity trends and suggested that the current selling pressure might precede a significant market event, emphasizing the strong connection between Bitcoin's price and macroeconomic liquidity conditions. As we bring you clips from their interview, kindly take some time to like this video, subscribe to the channel, and turn on post notifications for more informative contents like this. They would help boost the YouTube algorithm and support the channel's growth. Thank you for tuning in. Enjoy the rest of the video.
There's a much bigger context, broader context that we're talking about here. When you talk about the macro picture and what's going on with Bitcoin, we've been trying to figure out for a few months now, a couple months now, just exactly what's going on. And it's become clear that one of the drivers of the price action in Bitcoin recently has just been OG selling. You've had older coins coming out of dormancy and being dumped in the market. And if you look back from what I have read, it's about 1 million coins have been sold so far this year from older wallets, and hundreds and hundreds and hundreds of thousands of them in the last 2 months. And so what is going on? What's happening? Well, there's this long-term belief of 4-year cycles. We can talk about that. I actually believe that we don't have, we're no longer in a 4-year cycle with Bitcoin. I think that's broken. We'll talk about that in a minute though. But there's this long-term belief of that. And you've got these holders who've had these coins for many years, whether it's a decade and they bought 1,000 coins for $15,000 or whatever. And they've been, now they're worth $1 billion. That's well done. I keep saying this. I don't blame them. People ask, well, what are they going to buy with it? Are they going to buy stocks? Are they going to go they're going to buy, bonds? What are they doing? And the answer is, they're getting liquidity likely to shore up their, not just their own family wealth, but generational wealth. And I don't blame them. They're buying, whether they're buying houses or land or businesses or, or yachts, whatever they want to do. But they're able to do that. And it's been, it surprised the market, I think. The market didn't really expect it. And they didn't expect it because if you look back in the history of Bitcoin, again, let's go to first principles here. We have basically three or four data points for Bitcoin, and that's not enough. That's not really a data set. We do point back at these cycles and blow off tops and all that, but people expected some sort of blow off top this year in 2025, especially after the euphoria of Trump being elected and the new administration who's not antagonistic on Bitcoin and crypto, like the last administration. So all these things, you have these massive positive factors, the Bitcoin ETFs, a positive, administration, positive legislation, the repeal of SAB 121. Banks are now getting into it. You see institutions buying it. You've got JP Morgan building collateral products around it. Harvard is one of their core holdings is IBIT. Like, these are all massive positive developments. But the reality is that
the bank, the Luxembourg Sovereign Wealth Fund,
yeah, all that stuff. But the reality is you have a lot of uncertainty in the market right now. The uncertainty around liquidity, and we can talk about, what's going on in the repo market and bank reserves and all that stuff. But, what the Fed is doing, I'll let Larry talk about the Fed. He's probably a little bit more vicious about the Fed than I am, but you've got a bunch of buffoons in there, and I'll let Larry kind of take the ball on that one. But there's a lot of uncertainty, Brahm, and so you've had, I think, mentally in their mind, you had these OGs who are saying, you know what, 100,000, 125,000 doesn't matter. I'm getting out. I'm selling a portion of it, at least, maybe a third of it, a quarter, a third, a half. And some of them might have sold it all. I don't know. But it's a mental level, and it's clear because every single time that Bitcoin hit 110 and started creeping up to 120, there was massive selling, and a lot of selling from old wallets. So we're still in that. And I think that selling has begun selling, and now you've got some of the large institutions that have been buying over the last year or two that are up huge, and they're like, you know what, that's it. If the 4-year cycle is going to play out, then I'm out. I'm going to take my profits. I'm going to get this thing off my books. I'm going to dress it up because we're in October, November here, and you got to be doing that for institutions. They got to dress up they've got to window dress their portfolio for when they have the reviews. And that's all the stuff that's been going on in the background. Look at gold and look at gold's price and look at who's been buying it. It's been central bankers from across the world have been buying gold and buying a lot fewer U.S. treasuries, by the way. Why? Because they know damn well that two things are important here. Number one, if the U.S. government doesn't like what you do and you're not a close ally of them, then they may just kick you off the SWIFT network and take your treasuries. That's number one. Number two, and even back earlier this year, Putin even said it. He said, the U.S. government is going to keep printing money and they're going to keep debasing the dollar. Why would I want to own something that's going to be worth less in the future? Well, that's a good question. So they all know that they're trapped, and they understand that they don't want to be holding treasuries in an antagonistic environment or an uncertain geopolitical environment, especially the BRICS nations and the add-ons. So the BRICS Plus, there's a lot of nations out there who are moving away from treasuries. And Luke Groman talks about this quite a bit, and they're moving towards gold. Well, I think eventually they're going to move towards Bitcoin too, but that just hasn't solidified yet. We're getting there. We will get there, and I think that Larry hit on it. The overarching thesis is what we've defined on the expansion of global liquidity. The financial world operates on debt and liquidity. That's just what it is. And so that's number one. Number two, volatility is scary.
Yeah.
It's really scary. And so the people are sitting here going that have bought at 100, 105, 110, and now it's trading at $90,000. They're like, what have I done? I mean, this is just insane. Oh my God, this thing moves around, it whips around. It's unnerving. And I'll admit, I come from an arbitrage background before I did the microcap and private equity kind of world. Before that, I was in arbitrage, which was, if something moved 1 or 2%, it was catastrophic. It was like, wow, this is a massive move. You know, this thing has moved 1 or 2% 5 times in this conversation. You know, so and you just have to kind of and Saylor says embrace the volatility. And look, in a way that's right. Volatility it's necessary for an asset that's being adopted. It's just reality.
Yeah,
and it means that there's larger and larger swaths of capital that are moving in and out of it, and it's looking for those liquidity prices. You know,
recent price movements in Bitcoin have been notably influenced by the selling activity of long-term holders, often referred to as OGs. In 2025, a record volume of dormant Bitcoin wallets inactive for 5 to over 10 years have been reactivated and sold, totaling billions of dollars worth of Bitcoin. This surge in selling from older holders contrasts with the broader market optimism fueled by favorable regulatory environments, institutional engagement, and Bitcoin ETFs. Despite these positive factors, uncertainty remains high regarding liquidity and macroeconomic conditions, prompting many early investors to secure profits by liquidating portions of their holdings. These sell-offs often occur at psychological price levels, such as around $110,000 to $125,000, reflecting mental thresholds for profit-taking. The market's volatility is associated with this interplay of long-term holders cashing out while new buyers and institutions absorb the supply, creating a dynamic that impacts price stability and momentum. Meanwhile, global financial shifts, such as central banks favoring gold over U.S. treasuries amid geopolitical tensions, add to the complex backdrop influencing Bitcoin's price behavior this year.
So all these things are going on, which would, buttress our thesis. And, obviously the gold price has responded quite well to all those things. And that's because gold is more widely distributed, and it's always very good at sniffing out monetary debasement. And there's a very comparable period in 2018 to 2020 where gold moved first and then Bitcoin followed harder. And I think we're in one of those periods. And to me, remember, Bitcoin is kind of the perfect liquidity fire alarm, and it tells you how much liquidity there is in a system to an extent. It soaks it up. If there's too much, it soaks it up and it goes up a lot. And by the way, when there's not enough, it's also more sensitive than gold and it goes down more. And so to me, the fact that Bitcoin is drawing down is a very good indication that we're getting closer to what I think is going to be a trigger event that's going to lead to the big print. But we've seen this pattern before, and this is exactly what happened in 2008. And 18 and 19. There was the repo blowout in 19, then COVID in 2020, and gold was taken off like a rocket ship, and Bitcoin sat there flat as a rock, slightly down. And then one day it woke up and it went from 10,000 to 60,000 in 5 months.
Yeah.
And it was kind of like, oh, I get it. And that's what's going to happen. That's what's going to happen here. I don't know if it's going to do a six-bagger, but it's going to go up a lot. I would also like to add, not supporting the gold side, and just the overall macro picture that's positive, is that our trade now has a name. It's the monetary debasement trade. JP Morgan coined it that. And now Mohammed El-Arian and all these other elites are out there talking as if they invented the idea. Of course, there's some of us who've been saying this for decades. And, it's unusual. I mean, things that happened recently that I would never thought I would see happen. How's this for one? Morgan Stanley, one of the biggest wirehouses in the country, high end, with trillions of dollars in assets under management, changed their model from 60% stocks, 40% bonds to 60% stock, 20% bonds, 20% gold. And I was like, what?
Wow.
What are you talking about? And one of the gold guys did the math and said, well, if all of their clients actually followed that recommendation, gold would be at $12,000 tomorrow, because just given how big the Morgan Stanley asset base is. I don't know if he did the calculation right, but the point is, this is a very large change in sentiment. And so,
Druckenmiller says it. Galio says it. They're all. They're all allocated to an allocation to gold. Gold and Bitcoin, by the way.
Yeah, what's not happening though is, Bitcoin is the most sensitive to the liquidity piece. and liquidity is being drained. And so the other thing we need to have happen, I know James agrees with me on this, is we just need to have all these other crypto shitcoins die. Because there's a certain amount of, we're getting yanked around by them, because there's some Bitcoin holders who are only holding Bitcoin as an interim between their punts into Solana, and, now the new one, the hot new one now is Zcash, and all these are just pump and dump bullshit. But, when those things go down, some of those guys have to sell, and they have to sell their Bitcoin. So, it's all tied together in the liquidity swamp. But, throughout it all, Bitcoin just keeps ticking away, a block every 10 minutes. And, I have no doubt that we'll be at much higher prices. I have to say, I am surprised. I thought pretty likely we'd be at 140 by the end of this year. And I'm with James. I think the 4-year cycle is over. I think the 4-year cycle was kind of driven by the halving when the rewards were bigger. Now the rewards are so small compared to the IBIT buying and all the other stuff. I just don't think the 4-year cycle matters. I think there will be cycles just driven, like there are cycles in every market, just driven by fear and greed. And people will get levered up and get way too far out over their skis. And then, of course, things will correct. And so my model is still that we go to 250, and then we have a 50% correction. But one thing that also truncated the cycle in this particular thing was this whole notion, and I'm angry at a few of the larger influencers for pushing it, that these Bitcoin treasury companies were just free money machines. And that, you could basically sell at a premium, increase your Bitcoin per share and wash, rinse, and repeat forever, never accounting for the fact that the premium could disappear. And, that hurt a lot of people. And and there was a lot of money that probably there were some OG Bitcoiners. I know of a couple actually who sold some of their Bitcoin and to dump it into treasury companies. And, it turns out if you bought those at big MNAVs, you're now coming to learn why banks only trade at 1.5 to 2 times book value. One of the things I want to say about what I said earlier, I said this is a monetary debasement trade. And that's really wrong. It's not a trade. Okay.
It's not a trade.
A trade implies that, I'm in this for a while. And you're seeing that now. You're seeing You're seeing some of these Wall Street types. Oh, look, I bought Bitcoin at 60. It's at 100. I feel good. I made 100%. I'm out. No, wrong choice. Where are you going to go? It's a monetary debasement trend. And what I think people are going to be shocked by is how, 2 years, 4 years, 6 years, 8 years from now, gold's going to follow, the path upward towards, 6, 8, 10, 12. I could easily see $20,000 gold. And, Bitcoin's going to go 150, 200, 250, 300, 400. That power law projects that Bitcoin will be at $1 million in 2032. And I think that's probably right. It might be conservative. If we really have a big financial accident and they print a ton of money. So, to me, these are just, all you need to know is that both of these things are going up and to the right for many, many years. And we're probably in the second inning of at least a 9-inning game that might go into overtime. So, or extra innings. So, another stat that I'll cite, because I cited it in this presentation I just gave, it just blows my mind. It tells you what James is talking about, when we grabbed that sovereign debt from, when we grabbed those bonds from Russia. So since 2020, when COVID hit, in bond terms, Bitcoin is up 2,000%, 20x. And in gold terms, gold is up 277%, so almost 3x. So that's 20 years. That's the past 5 years. So that, to me, those two charts are prima facie evidence that we are in a sovereign debt crisis. And it's being expressed by these two alternative forms of money and how they're just kicking the ass on, of government bonds, because nobody wants those bonds. My clients, I run a gold and silver stock mining fund. So my clients tend to be older, more conservative. And they ask, a lot of them understand the Bitcoin thesis, and they ask me, how should I get in? How much should I buy? And I said, well, I think the way you look at it is this. We've had multiple drawdowns that have been big, some as large as 70%. I don't think we're going to have any more of those, but we could easily see 50 or 60. I think what you put into Bitcoin is a number where if got drawn down 50%, you would say to yourself, oh, that's a drag, but I'm going to buy more. Instead of saying to yourself, oh shit, I made a mistake, I'm going to sell it. Because, if you can hold it for 4 years, you're going to be money good on it again, right?
Lawrence Lepard explained that the current macroeconomic conditions seem to support what he called the monetary debasement trade, a concept popularized by major financial institutions like J.P. Morgan. He compared the current situation to the period between 2018 and 2020, when gold saw early gains due to fears about currency value erosion, and Bitcoin followed afterward with a significant price surge. Lepard noted that this pattern might be repeating now, observing that Morgan Stanley had recently adjusted its asset allocation strategy to include 20% gold, a move signaling a major shift in market sentiment. Despite this positive macro environment, he pointed out Bitcoin's sensitivity to liquidity constraints and noted that speculative altcoins disrupt the market as investors shift capital between Bitcoin and riskier crypto assets. He also expressed skepticism about the traditional 4-year Bitcoin cycle, suggesting it has ended due to changes in mining rewards and institutional buying dynamics. Lepard mentioned the 2025 Bitcoin price target of around $220,000, with a potential 50% correction ahead. He warned that exaggerated claims about Bitcoin treasury companies hurt investor confidence. Lawrence Lepard advised conservative investors to treat Bitcoin as a long-term strategy, recommending allocating a small, manageable percentage of their net worth to absorb potential volatility, rather than expecting immediate gains. He also highlighted striking gains Bitcoin and gold have made compared to sovereign debt since 2020, emphasizing the ongoing sovereign debt crisis's impact on alternative assets. How do you think Bitcoin's role as a liquidity alarm influences its price movements compared to traditional assets like gold? Please drop your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching. Don't forget to subscribe.